Hello, good morning, students. Today we will start our second book, that is Financial Management and Marketing Management. First, we will cover our first part, that is Financial Management. This book contains 4 chapters as well as 2 units, and this unit will include financial management and financial markets. Financial management is the chapter which will be a part of our first term syllabus, and this is concerned with the sources of business finance which we have studied in our 11th class. Most of the concepts it will be revised in this chapter. If we are very much clear about that chapter, so it would be very easy for us to understand these concepts. So let's see first of all that what are the topics we have to cover in this chapter. So we have to go for concept of financial management, its role and objective, and then 3 financial decisions are there, and investment financing and dividend decisions, and we have to go for the meaning and factors affecting these decisions. Then we have to go for the financial planning concept and importance. Then we will discuss the capital structure, the meaning of capital structure and the factors affecting capital structures. Later on, we will study about the fixed and working capital and their factors affecting the fixed and working capital. So let's move the meaning of financial management. When we say financial management, the word finance comes to our mind, as well as that business comes to our mind, and for doing a business that money is needed and how to arrange these funds. In our last class, we have studied about sources of business finance. There we were concerned with that company's sources of finance, because it is the company which is the largest form of business organizations, and if we know about the largest form of business organizations, we automatically know about the little bit smaller forms of business organizations. We know that how a company arranges the funds. So if you remember that companies sources of funds were divided on the various bases, somewhere on the basis of ownership, somewhere on the basis of time period, and someone on the basis of sources of generation. So when we have studied on the basis of ownership, we have studied about the owned fund and the borrowed fund. Definitely that owned fund and borrowed funds were also the part of generation basis as well as time period basis. So financial management is concerned with from which source the funds are to be raised, as well as when the funds are being raised, then how the funds will be utilized. So this is all about the financial management. First of all, how the funds will be procured, as well as what will be the how the usage of funds or the finance will be made. We have to, a business organization has to identify the available sources of finance and different risk and cost associated. Like if I say that business organization is going to arrange the funds from the borrowed sources, that is long-term bank loans, debentures, etc., then the cost, definitely these are the cheaper sources of finance, but the risk associated with it, that if the company is not able to make the payments to the to their creditors, that company's assets can be used for the repayment of these assets, these funds or these kind of debentures. So cost, as I have said, definitely these are the cheaper, but the risk associated is any default in payment would lead to the winding up or liquidation of a company. So any of the financial manager, when she is going to procure the funds, then they need the funds, they need to take care definitely that cost should not be increased with the benefits of that funds. So financial management always aims at reducing the cost of funds procured, keep the risk under control एंड अचीविंग इफेक्टिव डिप्लॉयमेंट. ऐसा नहीं कि आपने फंड्स रेज कर लिए और आपने फिर उस फंड्स को प्रॉपर वे में यूटिलाइज नहीं किया, तो व्हाट इट वुड रिजल्ट, डेफिनेटली इट वुड रिजल्ट इन द वेस्टेज ऑफ फाइनेंशियल रिसोर्सेज. So that's why the financial management is concerned with optimal procurement as well as uses of finance. What is to be done while doing the financial management? So definitely a business has to look before the size and composition of fixed assets of the business. Means how much amount will be invested in the fixed assets, maybe various kinds of fixed assets. The fixed assets may be in return to plant and machinery. The fixed asset may be land and building. Fixed asset may be furniture and fixtures. That it is to be decided that how much size is how much, and composition is that if a company decides that 10 lakh rupees is to be invested in the fixed asset, then how much to be invested in plant and machinery, how much is to be invested in the land and building, and how much is to be invested in the furniture and fixtures or other fixed assets. Now the second is that when the business, a financial manager has to decide or has to do the financial management, the another decision he has to take regarding the how much amount will be invested in the current assets. What will be its breakup value? Current assets, suppose total current assets are of 5 lakh rupees. Out of 5 lakh rupees, how much will be left in the how much amount will be left in the form of cash, how much will be left in the form of stock, that is inventory, and how much will be left in the form of receivables, that sometimes it may be in the form of credit sales or something in the on the basis of credits. So if you have to remember these 2 points, you have to consider the asset side of balance sheet, and the asset side of balance sheet mostly involves these 2 components, fixed assets and the current assets. Now come to the liability side. Liability side says that how much funds will be arranged, or when a financial manager is doing the financial management, she has to decide that how much funds will be arranged from the long term and short term sources. Long term sources means equity share capital, preference share capital, debentures, and short term funds means maybe in the form of bank drafts, maybe in the form of working capital, maybe in the form of creditors, and short term loans from the banks. Again, if a long term financing is to be done, then next will be how much to be raised from debt, that is borrowed sources, and how much will be raised from the equity, that is owned sources. I'm repeating, while learning these points, importance of financial management, keep the format of balance sheet in your mind, that the 4 major items in the balance sheet is current assets and fixed assets, and as well as on the liability side, current liabilities and fixed liabilities. So if we are talking about the asset side, then we have to consider that how much amount will be invested in the fixed assets and what kind of various fixed assets. The another one is that how much will be invested in the current asset, how much stock every time should be with a company, and how much cash should be with a financial manager or with the accountant. The next one is, if we think about the liability side, then the long term sources and the short term sources. Long term sources may be debt and equity. Even then, even here you have to decide that how much will be arranged from the debt and how much will be arranged from the equity. And the last point of importance is that how we are to spend on the interest as well as various expenses and the on the depreciation. That optimal expenses, when these items would be used judicially, when these expenses will be used judicially, definitely there will be sufficient profits, and which will help in the increase of business goodwill, business reputation. So it's all for the day. Thank you.